Good morning and welcome to today's webcast, Not-for-Profit Accounting and Auditing Spring 2019 Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the Slide Deck and Handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the Slide Deck and Handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Tammy Erickson, Partner, and Corrine Zajac-Clarkson, Senior Manager. And Tammy, I'll turn it over to you to get us started.
Great, thank you. Well, good morning, everyone. Thank you so much for joining us today. We have a lot of content here to go through, and so we will try to get through that as quickly as possible. So it may sound like we're somewhat rushing through our slides, and we probably are, but we will take some questions. I don't know if we will have time to respond to them, but if we don't, we will certainly try to get back to you at a later point in time. We do have some information here. Some of it, hopefully, you're already somewhat prepared for, and other information will be hopefully somewhat, maybe not hopefully, new to you. This is more of a FASB update rather than a GASB. We do have a GASB, I believe, 84 with the fiduciary funds coming up here next month. So we will be doing some content on some GASB standards as well coming up. All right. So today we just have our learning objectives here. We'll talk about implementing ASU 2016-14, the new financial reporting standard, which hopefully most people are getting close to being done with that, as well as the new revenue recognition standard. There's also a new standard related to grants and contracts that is really clarifying some standards. There's some new fair value disclosure requirements. They seem to always be updating those. Also, a new standard related to collections, cloud computing, and then just very briefly, we will touch on single audits. So our agenda, first we will talk about the new not-for-profit financial reporting standard. Then we will get into the grants and contracts and talk about some of the other newly issued standards, and then again that single audit update, which will be very brief. So with that, I will turn it over to Corrine, who will discuss the new not-for-profit standard.
Great, thank you, Tammy. So yes, our first topic that we'll be covering today is topic 958, not-for-profit presentation of financial statements. The objectives of the project was intended to be an update of the current financial reporting model and not a complete overhaul. The intention was to provide more useful information to donors, grantors, creditors, and other users of the financial statements. The standard attempts to improve the current net asset classification requirements, as well as financial statement and footnote information regarding liquidity, financial performance, expenses, and cash flows. The hope is to better enable not-for-profits to tell their financial story to the readers of the financial statements. So when is the standard effective? It is now required for 12/31/2018 entities and fiscal year-end entities ending in 2019. So adoption is now upon us. All provisions of the accounting standard should be implemented in the year of adoption on a retrospective basis. If presenting comparative financial statements, you can omit expenses by natural and functional analysis and disclosures of liquidity for any periods presented before the period of adoption. So it looks like we have come to our first polling question. Emily?
All right, our first polling question. Have you already implemented this standard? And your options are A, yes, B, not yet, but most of the way there, C, not yet, we've just begun, D, haven't even started, or E, haven't even heard of it. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. And if you're having any difficulty seeing the poll, you may try refreshing your browser with F5. And let's go ahead and take a look at the results. Corrine, back to you.
Thanks, Emily. Okay, great. Looks like quite a few people have implemented the standard and some not just begun. So that gives me a good baseline here going forward. So as a quick comparison between old GAAP and new GAAP under the new standard, the new standard attempts to solve the complexities in net asset reporting by collapsing down from the three categories of net asset classes into two, shown here as without donor restriction and with donor restrictions. For internal accounting and reporting, you will still track the net assets by restriction the same way as you always have. It's just a simplification in the reporting process for external financial reporting. So with donor restrictions include net assets that have donor or grantor imposed restrictions, and also includes underwater endowments, where in prior GAAP, underwater endowments were included in the unrestricted net asset class. Without donor restrictions include net assets that are not subject to a donor or grantor imposed restriction and includes all board-designated net assets, such as voluntary reserves and board-designated endowments. Here are a couple examples of the presentation of the two classes of net assets on the Statement of Financial Position. You will see that at the top section, here it shows the minimum requirement, breaking out net assets by without donor and with donor restrictions. However, in the second example, shows a further disaggregation within the two net asset classes, breaking out board-designated items within the without donor restricted category and the types of donor-restricted items in the with donor restriction category. Regardless of the presentation used, there is still a new requirement to disclose the amount, purpose, and type of board designation, which can be done on the face of the statement of financial position or in the notes to the financial statements, which I will show an example soon. This slide shows one example of how you might present the statement of activities under these two net asset classes. However, this is not the only way the information can be presented. GAAP still allows flexibility in presentation of not-for-profit financials, and you can also disaggregate further within the donor restriction column, such as by program restriction and endowment funds. So under the new standard, some disclosures are required for each of these asset classes. For net assets without donor restriction, you will need to disclose information about the amounts and purpose of any donor or board designations, which includes all board designations such as voluntary reserves, not only those related to board-designated endowments. For net assets with donor restrictions, you will continue to disclose information about the nature and amounts of each of your donor-imposed restrictions, with a focus on how and when the resources could be used, rather than a bright line distinction between temporarily restricted and permanently restricted assets. Another provision of the standard is related to the restrictions of donations and contributions for the purchase of property, plant, and equipment. For the donations of or contributions restricted for the purchase of PP&E, you can no longer imply a time restriction if not designated by the donor, and the new standard removes the option to release donor-imposed restrictions over the estimated life of assets. The new standard now requires you to use a placed-in-service approach. You must report expirations of restrictions used to acquire or construct PP&E and reclassify these amounts from net assets with donor restriction to without donor restriction at the beginning of the period adopted, unless those assets are not placed in service at the time of adoption. So remember, in the absence of explicit donor restrictions, not-for-profits would be required to use the placed-in-service approach. So here's an example of how you might present any reclassifications due to implementing the new standard. Sorry, it might be a little fuzzy, but down there in the bottom there's little stars. And here we're reclassifying out of with donor restriction to without donor restriction used for the place-in-service approach of PP&E, and we're also reclassing any underwater endowments, which I'll get to in a little bit here. So the total net assets, as restated, would tie to your statement of financial position. So here's an example issued by the FASB as a possible disclosure related to net assets with donor restrictions. This example shows in detail net assets restricted by a specific purpose, passage of time, net assets subject to a spending policy, subject to appropriation and expenditure upon a specified event, and net assets not subject to appropriation or expenditure. Again, this is just one example on how you may present this information. So now we are on to our next polling question.
All right, our second question. Do you currently have any underwater endowment funds? And your options are yes, no, or we do not have any endowment funds. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Give everyone a few more seconds. And let's go ahead and take a look at the results. Back to you.
Thanks, Emily. And this is kind of what we've seen as well. We haven't had a lot of underwater endowments, but there is a change in the standard, so I'll just go through it quickly. So current GAAP is to disclose aggregate amounts by which funds are underwater. The new standard requires you to classify the underwater amounts of donor-restricted endowment funds in net assets with donor restrictions. The update also requires disclosure of the aggregate fair value of underwater funds, the original gift amount, or the amount required to be maintained by donor or law, and the amount of the deficiency. The disclosure should also include the governing board's policy and decisions made to spend or not spend from these funds. So something to consider for December 31st, 2018, as you all are aware that the market did take a big hit. So where you may not have had underwater endowments in the past, you may want to retake a look, depending on what your fiscal year end is, and compare that original gift amount for your endowment. So here's an example of what the disclosure might look like. From time to time, the fair value of assets associated with individual donor restricted endowment funds may fall below the level that the donor or UPMIFA requires the not-for-profit organization to retain as a fund of perpetual duration. Deficiencies of this nature exist in 3 donor-restricted endowment funds. So here is where we disclose the aggregate original gift value, which is $3,500, the current value, which is $3,300, which results in a deficiency of $200 as of the current year end. And then we can go on to say that the deficiencies occurred such as from unfavorable market conditions and continued appropriation of certain programs that was deemed prudent by the Board of Trustees. Moving on to disclosures of board-designated net assets. So let's clarify what is considered board-designated. Net assets that require additional disclosure of the nature and amounts of board designations. So under FASB Master Glossary definition, board-designated net assets are subject to self-imposed limits by action of the governing board. So these include net assets to be earmarked for future programs, investments, contingencies, etc. If a governing board delegates designation decisions to internal management, these are also considered to be board designated and requires the additional disclosure. So even if there are no board designations, it would be a best practice to have policies regarding board designations of net assets. So also be careful to include only those amounts specifically set aside by board action. Here's a quick example of how you might disclose the board designation of net assets. It can be on the face of the financial statements or in the notes to the financial statements. Regarding liquidity and availability, the new standard now requires you to disclose information on liquidity and availability of assets. This means you will be required to disclose qualitative information on how the organization manages its liquid resources and disclose quantitative and qualitative information that communicates the availability of the organization's current financial assets at the statement of financial position date to meet cash needs within 1 year for general expenditures. So this really gives the opportunity for your organization to tell its financial story. I have worked with a number of organizations now that have implemented the new standard, and this section will require a bit more time and discussion in the management team and possibly involve the finance committee or board in drafting this disclosure. So this is an important disclosure, so planning ahead is definitely the key. So just as a quick recap, under old GAAP, there was no required disclosure regarding liquidity and availability of financial assets, and new GAAP requires a quantitative and qualitative disclosure of the liquid financial assets available for expenditure over the next year. So what should you consider when creating content for your qualitative information in the footnote? You will want information that is useful in assessing the entity's liquidity and that communicates how the entity manages its liquid and resources available to meet cash needs and the general expenditures within 1 year of the date of the financial statement position. So this may include a review of your formal policy for managing your organization's liquidity needs, such as a policy to keep enough cash on hand to cover 60 days of operating expenses, and considering discussions on potential removal of board designations in the future, also access to lines of credit and any other items that may be useful to the reader. So here's an example of what you might include regarding qualitative information. In this example, the not-for-profit has a goal to have a cash on hand to meet 60 days of normal operating expenses, and as a part of its liquidity management, invest cash in excess of daily requirements in various short-term investments, and the not-for-profit has a $2.5 million line of credit that is available to them should an unexpected event arise. Along with the qualitative information, you will include the quantitative information of financial assets and the limitations on those assets in the next 12 months from the financial statement date. There is flexibility on the format in presenting the disclosure, so the financial assets can be disclosed at gross or net of these limitations. So I'll show an example here in a second of what this might look like. So keep in mind, availability of financial assets may be affected by its nature, external limits imposed by donors or law, and internal limits imposed by governing board decisions. Here's an example of a disclosure which the entity begins with disclosing all financial assets and then removing those that are unavailable for general expenditure in the next year. So we start with $98 million and then reduce those assets for items such as investments held in trust or with others, long-term receivables, endowments, and board-designated endowments. With those items removed, the entity now shows financial assets available to meet cash needs for general expenditure within 1 year of $29 million. So this is the gross example. Here's another example, simply providing those assets available within 1 year of use. So this shows financial assets net of any limitations. So in regards to expense reporting, the new requirement is to present an analysis of expenses by function and natural classification. There are a few options in presenting this information. You can present it in the footnotes, in a separate statement, or as part of the statement of activities. Activities that represent direct conduct or direct supervision of program or other supporting activities would require allocation from management and general activities. Certain costs that benefit more than one function should be evaluated and allocated by function according to a specific criteria established by management, such as time studies or allocations based on square footage. The method of allocation should be disclosed in the footnotes. There is also new guidance on management and general expenses, which were general expenses where certain management and general expenses should not be allocated to program. So for example, human resources function generally would not be allocated to program, or grant accounting and reporting, such as providing a fiscal report, would be considered an M&G function and not part of a direct conduct or direct supervision of the grant. Also, legal expenses generally does not get allocated to program unless there's some legal matter related to a specific program or the mission. So as a recap, old GAAP required functional expense on the statement of activities and a disclosure of general policy of functional allocation, while new GAAP requires expenses to be presented by functional and natural classification with a few options for presentation. Disclosure method of the allocation of expenses by function is also more robust. So here's an example of what the expenses would look like by function and natural classification. So again, this isn't the only format, but it is a good example. Here's an example of a footnote disclosure on what expenses are being allocated and how the expenses are allocated. There needs to be a reasonable method of allocation, and from an auditor perspective, we would ask for this allocation calculation as part of the audit. So next steps. So from experience of entities who have already implemented this standard, this expense reporting section takes time to pull together and developing a methodology of allocation. So entities may have been allocating expenses but may not have had a formal allocation process or haven't evaluated the adequacy of the allocation process for several years. So we have found that this requirement has taken more time than anticipated for management to implement and requires involvement of different departments within the organization to obtain accurate allocation. So for example, if you are allocating based on time studies, you may need those department heads to assist you in that. So planning ahead is definitely key for this provision. Moving on to investment return, the financial statements must show a net presentation of investment return and expenses. So this is meant to provide a more comparable measure of investment returns across all not-for-profits, regardless of whether investment activities are managed by internal staff or outside investment managers, or have investment vehicles that have management fees that are already embedded in the investment return. So the hope is that there will eliminate inconsistencies in the reported amounts of the investment expenses. So as a note of clarification, the guidance does not apply to programmatic investments. So for example, if the organization has a program activity of making loans or other investments that are directed at carrying out the entity's purpose for existence, in other words, its mission, rather than investing in the general production or of income or appreciation of the asset, so regular investments. So you would be not including this in that programmatic investments. So the standard no longer requires a disclosure of investment expenses. However, if reported, carefully label and don't include them in the functional expense analysis, since they are netted against the investment returns. So again, a quick recap. Under old GAAP, investment return and expenses are presented at gross, and there was a requirement to disclose the gross investment income and expenses in the footnotes. Under new GAAP, investment return is presented net of internal and external direct investment expenses and eliminates the required disclosure of gross investment income and expenses in the footnotes. The new standard also provides an update to the statement of cash flows. Organizations still may choose between the direct method and indirect methods. However, if direct method is used, you are no longer required to show a reconciliation to the indirect method. We really haven't noticed a change in the way organizations have been reporting their statement of cash flows when implementing the standard. So it seems like most organizations are happy with their current presentation, but just know that a reconciliation is no longer needed if you use the direct method. So next steps. If you haven't already started implementing the new standard, this is a good time to look at your current policies that you have in place and whether updates should be made, and communicate with your board on the changes coming up, especially for the liquidity footnote. Remember that this is your chance to tell your organization's financial story and the message you want to send to the readers of your financial statements. We are always here to help, and we will continue to provide insight on the new requirements as well as implementation suggestions. Moss Adams has developed a financial reporting standards guide that aids in implementation of the new standard, which we would be happy to share with you. So send us a message in the Q&A section and we can make sure that guide gets to you if you need it. Now we'll turn it over to Tammy to discuss topic 606.
Great, thank you so much, Corrine. All right, so topic 606, This is the new revenue recognition standard, and there's been a lot of work on FASB's side as far as converging to international accounting standards, and so this is what this does. And really the biggest change here is moving more from a rules-based accounting to more of a principle-based focus when it comes to looking at revenue recognition. Not all revenue sources are impacted by this, so you do need to consider what the revenue is. So for example, revenue from contributions and investment income are scoped out of this topic 606. Contributions, the reason for that is they're considered voluntary and non-reciprocal, and we will talk about that here briefly or in a moment after we're done with this topic here. Contracts that have both an exchange component as well as a contribution component may need to be evaluated, as the exchange component would likely have to be accounted for under this topic 606, while the contribution component would be under the new ASU 2018-08. All right, so what this does is moves again to more of a principle-based standard rather than rules-based. It's a 5-step process, and so you have to go through that process to analyze the contract to then determine how you should account for that. Some organizations do have multiple contracts with multiple customers, and if those contracts are all written similar, then you can use this portfolio approach to help with that implementation. It is effective for public entities for years beginning after December 15th, 2017, so that would be June 30th, 19, or December 31st, 2018, or a year later for those non-public entities. And of course, the early adoption is permitted. Here's the 5-step process related to this. Step 1 is just identifying whether or not you have a contract itself. Once you've identified a contract, then you want to figure out, do you have different performance obligations within that contract? So the contract might have multiple elements to that contract, and you need to separate out those elements and then determine the transaction price of the overall contract, and then allocating that transaction price to those various performance obligations within the contract. And then the last step there is really recognizing that revenue once those performance obligations have been identified. We are not anticipating that this is going to have a significant impact on not-for-profit organizations. It depends upon, obviously, what your various revenue streams are. For universities, tuition and fees, this could have a moderate impact on them. As I mentioned earlier, grants and contracts, contributions, investment income are scoped out of this. Rental income is also scoped out. There is the new leasing standard that is coming up. Changes in split interest agreements are scoped out. Auxiliary revenues, which again is more of a higher education type of revenue, there could be some moderate impact. And then other income is probably where you're really going to have to look is, do you have any significant contracts out there that fit in some other category that you do need to consider for this? So again, we're not expecting any significant changes, but something to keep in mind as you're going through and implementing some of these new standards. because of this standard, there were a lot of questions related to grants and contracts and how those apply to this new revenue recognition. And so FASB ended up coming out with a new standard here, this ASU 2018-08, which is grants and contracts to not-for-profit organizations. And really there isn't a lot of new guidance here. It's really clarifying guidance. But I do encourage you to read through that in your spare time if you maybe need to sleep well at night. That standard, it does have a lot of really good examples in this. So we are going to go through some examples, but when you are analyzing this standard, so when you have a grant or contract coming in, you need to consider two different things. One, is it reciprocal or non-reciprocal? Do you have an exchange transaction or is it a non-exchange transaction? That's the first thing that you need to identify. Once you've identified that, assuming you have, if it is an exchange transaction, then you're going to look back at that topic 606 or that revenue recognition that we just discussed. If it's non-exchange, then it's going to fall under this standard. And once you've determined that it's a non-exchange transaction, then you also need to go on to a second step and determine whether that is conditional or unconditional. FASB literally just yesterday issued a Q&A on this, and so that is out now. I have not had time to read it because I just found out about it this morning, but that is out there to help with this. All right, the scope of this, it does apply to all entities, so both not-for-profits as well as business entities. So those receiving contributions, the nonprofit organizations, but also those making those contributions. It does exclude assets from governments to business entities. So sometimes a for-profit organization may have a contract with the government. It does not. Those are scoped out of this. The intent is to apply this guidance to both entities, but you don't have to make sure that you're doing the same accounting as the giving organization. And then lastly, just something to keep in mind is the way that you've termed things within your financial statements themselves really does not factor into how it's accounted for. You really have to go through the contract itself to determine whether it is an exchange or non-exchange transaction, and then again whether it's conditional or unconditional. So we're going to go through some examples because I think this will really help to solidify the standard and what they are trying to clarify within the standard. So here's an example where, as I mentioned, we have to look at first, we have to determine is it reciprocal or non-reciprocal or an exchange transaction, non-exchange transaction. So here they clarify the guidance within the standards. Again, this is more of a principle-based rather than a rules-based. So keep in mind that a resource provider is not synonymous with the general public. So even though the governmental entity may be giving funds that is benefiting the general public as a whole, that governmental entity then is not receiving direct value. If the primary beneficiary of a grant or contract is a third party, then make sure that you're using some judgment determining whether you have an exchange transaction or not. Also, if you are receiving funds and you're getting that feel-good sentiment that does not constitute commensurate value. And then the type of resource provider should not override the substance. So again, this is really a principle-based standard. Here we have, just to show you visually, under current practice, if it's an exchange transaction, you're really considering who is receiving the benefit. If it is the resource provider that's receiving that benefit, if it's a specific third party, so a specific individual, you need to consider that and whether or not that would be an exchange transaction. And under that current practice, the general public has oftentimes been considered as receiving the benefit and that was an exchange transaction. Under this new clarification, that is then where you're going to see the differences. That general public then is really now considered a non-exchange transaction. They are not the ones that is the resource provider and therefore receiving the benefit. Those that are receiving the direct benefit, again, that's going to be under the topic 606. All right, so let's get into some of the examples here. So this is similar to your general grant from the federal government. So not-for-profit is awarded a grant from the federal government. The agreement itself requires the not-for-profit organization to follow the rules and regulations established by OMB. The grant requires that the nonprofit send an annual audit in under the Single Audit Act under OMB guidance, and the federal agency requires a summary of the research findings to the federal government. It's a research grant. It also requires that any unused funds are forfeited to any, as well as any unallowed costs that have been drawn down must be refunded. The not-for-profit organization then retains the rights to the findings after they've performed the research. So again, we have to first determine whether this is an exchange or a non-exchange transaction. So here's what we have here. This is considered a non-exchange transaction. So commensurate value is not being exchanged between the two parties. Even though the government is receiving the report back, a summary of the report, the not-for-profit organization is retaining the rights to those findings, and therefore there is not an exchange transaction that has happened here. The federal government's benefit is considered indirect in that case, and it's really the general public that is getting the value from that. Now, if this had been slightly different, let's say that the government had contracted with the nonprofit organization to do research on, say, daylight savings time. That's been a big topic. And the government retained the rights to those findings. So the nonprofit did all the research. They sent the research back to the government retained the rights to that research. Then that would be a different conclusion. That would be an exchange transaction in that case because the resource provider, the government, is receiving value for the work that was being done. All right, here's then issue 2. So as we mentioned before, first you have to figure out is an exchange or non-exchange. So for those that are considered non-exchange, then you have to look at the second issue, which is whether or not there are conditions or not imposed on that donor. So for there to be a condition, there has to be a right of return or release of those funds. So in other words, if the donor, or if the nonprofit organization does not meet those conditions, then the resource provider would receive those funds back. The nonprofit organization must return them. But not only that, there also has to be a barrier. And that we're going to go through some examples here of that in a moment. But they did look at an alternative of just whether or not there'd be a right of return, but that would have required a lot of probability analysis and could have been really difficult to assess that. So instead they've come up with not only this right of return and release, but that there also must be a barrier. All right, so here's some examples of the barriers. With a barrier, you're going to have some kind of a measurable performance-related barrier or other kind of measurable barrier. Maybe it's that you have to provide so many services within a certain amount of time if you're helping certain individuals. You also need to look at the extent to which a stipulation limits the discretion by the recipient on the conduct of the activity. So you have to consider how much discretion does the not-for-profit organization have with regards to that potential barrier. And then whether or not that stipulation is related to the purpose of the agreement. So again, let's walk through some examples to get a better sense of this. So in this case, let's say a not-for-profit organization receives a grant from a private foundation for funding in the amount of $100,000 to provide specific training to child care providers. The grant requires the nonprofit to provide training to at least 1,000 child care providers during the next fiscal year with specific minimum targets that must be met each month. There's a right of release from the obligation within the agreement. So, first of all, we have to again go through, is this exchange or non-exchange? So in this case, this would be a non-exchange transaction. And then we have to consider whether it's conditional or not conditional. So again, we have to consider those two criteria. One, is there a right of release? And then two, is there a barrier? So in this case, the organization would consider this to be conditional. So there is considered a barrier because there is that right of release if they do not meet the criteria, and there is the barrier where there's some specific levels of service that must be met in order for that nonprofit organization to receive the funding. The likelihood of receiving those minimums is not considered itself. It's just whether or not they meet them is when they would recognize that revenue. Here's another example to look at. So in this case, a nonprofit provides services to the homeless. They receive a grant of $10,000 upfront from a foundation that's to be used towards its housing program. So consistent with the grant proposal itself, the grant includes some stipulations about how the nonprofit should use the assets. For example, they say that they're going to hire a program manager that they wrote within the grant proposal itself. And the grant does not specify that the entitlement to the $10,000 is dependent upon meeting any of the stipulations in the agreement as long as the funds are used towards the housing program itself. The grant does contain a right of return for funds that are not spent on the housing program. So first, we have to consider again whether this is an exchange or non-exchange transaction. We do determine it is non-exchange because the resource provider is not receiving direct benefit. It's non-exchange transaction. It's the general public that is receiving that benefit. But then we have to consider now whether it's conditional or unconditional. So in this case, it would really be unconditional. Even though there's some stipulations about how those funds should be used, for example, with the program manager that will be hired, the nonprofit really does have some discretion over how those funds are used. And therefore, although there is a right of return, there is not a barrier there. So those two criteria are not met in this example. Those the budget that's included in there is really considered guidelines rather than specific stipulations. There's been discussion about, limited discretion and, for example, budgets. When does a barrier really exist? How much discretion does the nonprofit organization have versus the awarding resource provider? So here's an example. This is basically the same example as our very first example where we determined that we had a non-exchange transaction. This is really your typical federal award that a nonprofit will receive from a federal agency. So again, federal agency provides funds to a nonprofit organization. The organization must follow the OMB guidelines, must perform a single audit. There's research findings that have to be provided back to the federal government. Any unused funds have to be returned to the government, and the nonprofit retains rights. So in this case, this grant would be conditional. And that is because the grant agreement limits the nonprofit's discretion on the conduct of the research as a result of the specific requirements on how the assets may be spent. It's because of those qualifying expenses and looking at your procurement protocol that limits that discretion. And therefore, this would be considered conditional, and there would be and because there is a right of return, it does meet both of those. Here's another example. This is a grant from a corporate foundation. So a research clinic within a university works with gluten-related allergies as part of its overall mission. It applies for and receives a $100,000 grant from a corporate foundation to perform research on gluten-related allergies over the next year. The agreement includes a right of return, a statement that approval must be obtained from the corporate foundation for any significant deviations in spending from the general budget, and a requirement that at the end of the grant period, a report must be filed with the corporate foundation that explains how the assets are spent. So first, is this a non-exchange transaction or not? This would be because the nonprofit is retaining those rights. And then is it conditional or unconditional? In this case, they would consider it unconditional, and that is because the general budget is not considered a barrier. It does allow for pretty broad discretion on how those funds are expended. So even though there's a right of return language, the barrier itself does not exist. And the reporting requirement is not considered a barrier. That's administrative only, and therefore it's not considered related to the purpose of the agreement. Something to keep in mind, however, is because this is for gluten-related allergies, it is narrower than the university's overall mission, and therefore the funds are donor-restricted revenue to that university. And those would be released at the time that the restriction was met. This just gives you an overall look at kind of a flow chart as far as One, looking at whether you have an exchange or non-exchange transaction. Payments for a third party on behalf of an existing reciprocal transaction. So as an example, the federal government, Medicare, Medicaid is a great example where the federal government is providing funds for a third party. Because those funds are typically for a specific person, they go in, see a doctor, the federal government pays on their behalf. That is considered an exchange transaction because it's not the general public that is receiving it. It is a specific individual that is determined at the time. So that is something to keep in mind. And then again, here is whether or not it's conditional or unconditional, looking at this on a flow chart. The decision, again, is based on whether a barrier that must be overcome and has either a right of return of the assets transferred or a right of release of the promisor's obligation to transfer the assets is determinable from the agreement. So you need to look at that agreement to make that determination. The presence of both a barrier and a right of return of release indicates that the recipient not-for-profit is not entitled to the transferred assets until it has overcome those barriers in the agreement. Prior to overcoming those barriers, the contribution would then be considered conditional and would not be recorded as revenue yet. After a contribution has been deemed unconditional, then the entity would consider whether the contribution is restricted on the basis of the current definition of the term of donor-imposed restrictions, which Corrine had talked about in her presentation. We do believe that this could result in more grants and contracts being accounted for as contributions than under the current guidance. So this does, again, help clarify that. This will likely have an impact on government agencies, individuals and corporations, and foundations. Something to keep in mind, it probably with individuals, there probably won't be very many times in which there's going to be a conditional gift because with those barriers, then that gift likely would not be tax deductible if there was that right of return. However, with capital pledges, that might be an area in which you see that. So with this new guidance, there's really going to be these two buckets. You're going to have funds that are restricted that may be conditional because they've had that barrier and right of return, and then the other funds that are just generally restricted. Keep in mind.
I'm just going to interrupt real quick because we have 2 minutes left and 2 polling questions that we need to push out to our attendees.
Thank you.
So I'm just going to push out these 2 questions, and then we can continue for those of us that don't have a hard stop. So our third polling question, do you think this will have an impact on the way you've been accounting for your grants and contracts? And your options are yes, no, or we need some grants and contracts before I worry about it. And again, sorry for the delay on our polls. We have a lot of content to get through for this webcast. So we'll do this one, and then we'll have one more right after. Give everyone a couple more seconds here. And let's go ahead and take a look at the results, and we can come back to this. I'm just going to skip ahead to that final 4th polling question, which is, do you have any level 3 fair value measurements disclosed in your financial statements? And your options are yes, no, or fair value what? And again, just a few seconds to make a selection. And once you have completed all CPE requirements today, you'll be able to download a PDF of your CPE certificate from the certification widget to the right of this slide view. You can also download a copy of today's presentation in the slide deck and handouts widget. And let's go ahead and take a look at the results. And Tammy, I'll turn it back over to you to continue with the presentation.
Great, thank you. Yes, sorry. Again, we knew we had a lot of content here, and this would be difficult to get through, but a lot of important information with this. Sorry, I'm going to find where we were here. Whoops. All right, so just again, one thing to remember is if you do have a policy that if a restriction is met in the same period in which it came in, then you do not have to account for that as restricted and then release it to unrestricted. It can all go in unrestricted if that is your policy. So make sure you're updating your policy if that is your intent. For disclosures, recipients and resource providers, there's really no additional reoccurring disclosures that have been added. Again, with conditional promises to give, there are disclosures that are required, the amount that's been promised, as well as a description related to that. For transition approach, it is a modified perspective, so it applies to all agreements that exist at the effective date, and you want to look at the amount of revenue that has not been recognized yet. So if you've recognized revenue in the past, you're not going to change that. It is just any unrecognized revenue going forward that you're looking at, so there is no restatement of prior amounts, and then obviously new agreements that are entered into after the effective date would be applied as well. Some of the implementation issues that have come up have to do with this cost sharing as well as the limited discretion. So, talking about the budgets and how much discretion does that organization have over that. We had in the slide that FASB is working on implementation materials and that there may be a Q&A. I found out this morning they have now issued that Q&A. So that is something that I would encourage you to find and review if you think that would impact you. We went through the polling questions here. Leases, as many of you know, are applicable. Corrine, I'll have you talk briefly about that.
Thanks, Tammy. Yes, so leases, we've been talking about the standard for quite a while. I'll just go through it really quickly. So under the new guidance, which was issued back in February 2016, the lessee will be required to recognize assets and liabilities for leases with lease terms greater than 12 months. So the lessee should recognize the statement of financial position, a liability, to make lease payments, and the right of use asset representing its right to use the underlying asset for the lease term. There still continues to be a differentiation between finance and operating leases. This standard is effective for December 31st, 2020 for non-public business entities, and for 2021 for fiscal year-end entities. So just briefly, since this new standard came out in 2016, the FASB board has held many meetings regarding the implementation of the new lease standard that you need to be aware of. So the following newly issued standards have come out to assist organizations in their transition efforts to the new lease standard. So if any of these items apply to your organization, I would encourage you to take a look at these standards, which will hopefully clarify some implementation questions as you prepare to adopt Topic 842. So Again, a shameless plug, Moss Adams does have a lease accounting guide that could help you, kind of runs through some of the things that you should be considering when you're doing the implementation of Topic 842. We also have some examples of accounting adjustments to aid in the implementation process. Statement of cash flows, and we already did our polling question. So we found that not a lot of entities have restricted cash that's disaggregated on the Statement of Financial Position, but just know that this standard enhances the Statement of Cash Flows by streamlining activities between cash and restricted cash as operating, investing, or financing, or a combination of these activities. So this update requires the Statement of Cash Flows explain the change during the period in the total cash, cash equivalents, and amounts described as restricted cash or restricted cash equivalents. So therefore, restricted cash and restricted cash equivalents should be included with cash and cash equivalents when reconciling the beginning of the period and end of period total amounts shown on your Statement of Cash Flows. So here's a fair value measurement topic. I'll just go briefly. I know we are pressed for time, but basically this ASU eliminates certain disclosures under topic ASC 820. So the amount, it eliminates the transfers between level 1 and level 2 fair value hierarchy, the timing of policy for transfers between the levels, the valuation processes for level 3 fair value measurements, and for non-public entities, which includes not-for-profits, the change in unrealized gains and losses for the period included in earnings for level 3 recurring measurements held at the end of the reporting period. There are some modifications also to disclosures. They're no longer required to prepare a roll forward for level 3 investments, so yay on that, actually reducing the amount of disclosure, which is nice. However, be required to disclose transfers into and out of level 3 and purchases and issues which are to be disclosed separately in the footnotes. So these new amendments are effective for all entities for interim and annual reporting periods beginning after December 15th, 2019. So early adoption is permitted for all entities. An entity is permitted to early adopt any removed or modified disclosures upon issuance of this ASU for which financial statements have not been issued or made available for issuance, and delay adoption of additional disclosures until their effective date. So these amendments will be applied prospectively for disclosure of the changes in unrealized gains and losses, the range and weighted average used to develop significant unobservable inputs for level 3 instruments, and the narrative description of the measurement of uncertainty. So all other changes should be applied retrospectively. So that's all I had. Tammy, would you be able to quickly go through the remaining slides?
Yeah. I think what we'll do is we'll go ahead and cut it off here. We really want to be respectful of everybody's time. So again, we both apologize for going over. Yes. There are a lot of changes impacting nonprofits, so we felt it was really important to spend the time on those first two topics. Feel free to peruse the slides. As we mentioned, they are available. So I'm going to turn it over to Emily.
All right, thank you, Tammy, and thank you, Corrine, for a great presentation today. Obviously, we had a lot of content to get through, and as Tammy just mentioned, you can download the full slide deck now. We'll also be sending that via email after the webcast. Many of you asked for copies of the implementation and the lease accounting guides, and we'll be happy to include those in our follow-up email. If you have any questions for our presenters, you can still enter those in the Q&A window now, or you may reach out to them directly. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, Your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.